Derivatives backtesting is the process of creating a time series of historical prices for derivatives. There are many benefits to this, and several different ways to do it depending on your needs. For reference, here's a chart of Apple's stock price over the past 3 years. We've all seen this type of chart many times. Why are these charts so popular? They give us perspective on the range of prices, and whether that range is large or small. Technical analysts use the past movements to predict where the stock will trade in the future. Resistance levels are easily seen. We get a quick feel whether the company is growing fast, is stable, or shrinking. It's the fastest way to get a first impression of the stock's performance, and a host of other reasons. Now here's a chart of an Apple option over the past 3 years, which is really less than 1 year of data. Why only 1 year? Because the option only started trading a year ago. How about a chart of an over-the-counter 5-year interest rate swap that was initiated 3 years ago? We have no chart for that because the swap hasn't traded since it was initiated. How about a table of trade prices for a corporate bond? Here's an example with just a few dates in the past because most days it didn't trade, as most corporate bonds are fairly illiquid. Well, if the Apple stock chart is worth generating, it stands to reason it would be just as helpful to have the same chart for the option, the swap, and the bond. That's what a backtest gives us. Here's a chart of that swap for the past 3 years, generated in OTC backtesting and risk. How did we create it? By going back each day, getting historical yield curve data, and using SavvySoft's award-winning pricing models to get a theoretical price for the swap each day. Here's the chart of the Apple option going back 3 years, again generated by OTC backtesting and risk. This was created using Bloomberg's historical data for Apple stock price, Apple option implied volatility, and US LIBOR rate. These charts were generated in less than 30 seconds each, with less than 10 keystrokes in mouse click, because OTC backtesting and risk was created specifically to build these types of charts. Other ways to backtest. The Apple June 2016 call had a long time to expiration in 2013 and much less in 2016. The 5-year swap had a longer maturity in 2013 than in 2016. In both cases, the risk-return profile of the instrument was changing over time. Often, we want to calculate statistics such as mean, standard deviation, and volatility and correlation, which requires each data point to be drawn from the same distribution. This requires that the backtest be for a constant expiration and/or maturity, and for the option, constant moneyness as well. This gives us 4 rebalancing rules. This leads to 4 possible ways to run the backtest. We can either have a constant expiration date, in other words, we roll down the expiration, or we have a constant term to expiration, which means no roll down to expiration. Combine that with either a constant strike price or constant moneyness. So we have 2 combinations of 2 things, or 4 altogether. VAR, value at risk. VAR also lets us keep the risk return profile constant across all scenarios. In a backtest, we use actual prices in the option model. In other words, the return over a given period is the option value using price 2 minus the option value using price 1. VAR, use today's price and today's price adjusted for actual historical returns in the option model. So the return is the option value using today's price times the ratio of P2 over P1 minus the option value using today's price. The 4 types of rebalancing, along with VAR, are each available within OTC backtesting and risk via a pull-down list. There are actually 2 types of VAR available and 2 ways to define constant moneyness, leading to 7 choices for the type of rebalancing. To recap, we've seen how useful it is to look at charts of past performance and shown that OTC backtesting and risk can very quickly and easily be used to create time series for options, bonds, and swaps where there is a serious lack of real-world data, and also how different rebalancing rules can be applied to create exactly the type of time series you need.